Now, Federal Reserve Chair Janet Yellen tells the Joint Economic Committee that a rise in interest rates may occur relatively soon and discusses the various factors contributing to that decision. This is an hour and 45 minutes.
Excuse me, the committee will come to order. We're welcoming this morning Chair Yellen, Federal Reserve Chairman. I would like to just announce to my colleagues, and many of them will be filing in shortly, we have a hard stop at noon, both for the chairman's sake and we have a Senate vote at noon. So we're doing everything we can as chair to get everybody the opportunity to ask questions of the chair, but to my colleagues, it's a hard stop, so we're not going to be able to go beyond that time frame. The Joint Economic Committee has a long tradition of receiving regular updates from the chair of the Federal Reserve, and we're pleased to hear the chair's insights once again before the Congress adjourns for this cycle in 2016. While we have seen some encouraging metrics of economic performance over the past year, the next Congress and the next administration will still face a number of challenges. 8 years after a deep recession, we're still looking for a higher rate of GDP growth, stronger productivity growth, and increased work opportunities, especially for prime-age workers. Low interest rates have historically been the prescribed treatment for a weak economy. However, the past 7 years have clearly taught us that low interest rates alone cannot cure an ailing economy. In response to this continuing challenge of stimulating growth to a more desired level, there seems to be a growing consensus forming that tax and regulatory reforms, plus fiscal stimulus measures such as targeted infrastructure initiatives, may be necessary ingredients, or perhaps are necessary ingredients, to incentivize capital investment and GDP growth. But as we pursue these policy changes, we also have to be mindful of a nearly $20 trillion national debt that looms ominously over the U.S. economy. Where debt to GDP stood at 39.3% in 2008, it will total 76.6% by the end of this year, according to the CBO analysis, and will climb to 85.5% over the next 10 years. We look forward to hearing the chair's thoughts on this economic outlook, as well as the types of policies that Congress perhaps should be looking at and considering during this time of change. I now recognize Ranking Member Maloney for her opening statement.
Thank you. Thank you so much, Mr. Chairman, and for your leadership. This is likely the last hearing of the Joint Economic Committee in the 114th Congress, and I'd like to sincerely thank Chairman Coates for his stewardship of the JEC and for holding a number of very interesting hearings that have generated excellent discussion. I'd also like to thank my colleagues on both sides of the aisle and to welcome Martin Heinrich as the ranking member on the Democratic side, and to express my appreciation to Ms. Klobuchar, who is going, I understand, to be ranking on rules. I'm particularly pleased that we are ending on a very high note with Federal Reserve Chair Janet Yellen. Chair Yellen, I think it's fair to say that all my colleagues warmly welcome you to this hearing and look forward to hearing your thoughts at this critical time. I'd like to begin by thanking you for your extraordinary and careful leadership of the Federal Reserve. The Fed has played a critical role in helping our country recover from the worst recession since the Great Depression. Your steady hand has built on the work of your predecessor and has guided the economy forward, and we thank you. Much has changed since you appeared before the committee about a year ago. The economy has continued to strengthen. The labor market has continued to improve. Wage growth has been the strongest since the recession. Household income has had the largest annual increase since census began tracking this data. Inflation has edged up, though it remains below the Fed's 2% target. These are among the tea leaves of the economy, and everyone here is eager to find out how you read them. Up until very recently, it was widely assumed that the Federal Open Market Committee would raise interest rates at its next meeting less than a month from today. Some of your past statements have indicated that this is a possibility or even a goal. But then came a thunderbolt on November 8th. Many critical changes about our country changed literally overnight, and our world has been turned upside down. The question everyone would like to know is how the Federal Reserve will steer through the days ahead. One particular challenge is that the President-elect has called for policies that may have countervailing effects. History has shown us that the type of tax cuts candidate Trump has proposed disproportionately benefit those who don't need them and dramatically increase our national debt. I'm also curious to see how President-elect Trump's infrastructure plan be reconciled with the Republican Congress's past opposition to fiscal stimulus. There is a great deal of uncertainty about fiscal policy, and that leads to uncertainty for markets, businesses, and the economy overall. One constant hope that I have is that we can count on is monetary policy that remains insulated from political attack and attempts to meddle in any way with the Federal Reserve's independence. The election could also have a direct effect on the Fed itself. The President-elect's comments on this subject have been somewhat contradictory. He thinks both that the current low interest rates are good for the economy and that the Fed has been being political in keeping them at these levels. In Congress, some have called for revolutionary changes for the Federal Reserve, changes that would affect the very nature of the institution, changes that, in my opinion, would lead to disaster. For those who would like to restrict the independence of the Federal Reserve, I think it's important to briefly review that immense benefit of an independent Federal Reserve. We have only to look back a few years. When President Obama took office, he inherited from what former Fed Chairman Ben Bernanke called, and I quote, "the worst financial crisis in global history, including the Great Depression," end quote. The Federal Reserve quickly acted to lower rates to almost zero and has held them there for about 8 years. It instituted several rounds of quantitative easing to further stimulate the economy. This action by the independent Federal Reserve was critical to our recovery. Economists Alan Blinder and Mark Zandi found that efforts by the Federal Reserve and the Obama administration, with support from Democrats in Congress, dramatically reduced the severity and length of the Great Depression and recession and prevented a depression. With control of the legislative and executive branches, past Republican efforts to limit the Fed's independence may gain momentum. Last year, Republicans in the House passed legislation, the FORM Act, that would fundamentally hamper the Fed's ability to to conduct monetary policy. It would limit the Fed's independence by forcing it to determine target interest rates using a mathematical formula, while ignoring a broad range of important economic indicators. Chair Yellen, as you noted before, if the Fed had been forced to follow such a rule in recent years, and I quote, millions of Americans would have suffered unnecessary spells of joblessness over this period, end quote. Another proposal to jettison the Fed's mandate to try to maximize employment and instead focus solely on inflation. I'm not sure that people in Michigan and Pennsylvania and other states would respond well to that suggestion. But if that's the conversation my colleagues want to have, then we'll be ready to have it. The past 9+ years have been an extraordinary period in the U.S. economic history. We should continue to study and learn from it. We are not out of the woods by any stretch. When the next recession hits, as it surely will, what will the monetary response look like? Will the Fed have the tools to restore growth? Will it return to quantitative easing? What other effective policy tools will the Federal Reserve have at its disposal? I want to make one final point. The Federal Reserve has been at the center of the U.S. and global economic recovery. Efforts to hamstring the Fed are misguided, just as efforts to politicize it are wrong-headed. Chair Yellen, thank you for appearing before the Joint Economic Committee today. We look forward to your testimony. Thank you.
It's now my privilege to introduce to you Chair of the Board of Governors. Janet Yellen has long experience at the Federal Reserve, including 4 years as Vice Chair of the Board of Governors and 6 years as President and Chief Executive Officer of the Federal Reserve Bank of San Francisco. She previously served as Chair of the Council of Economic Advisors under President Clinton and as Chair of the Economic Policy Committee of the Organization for Economic Cooperation and Development. Chair Yellen earned her Ph.D. in economics from Yale University and is also Professor Emeritus at the University of California at Berkeley. It is my pleasure, Chair, to introduce you as our witness today and to thank you for your always accessible presence for this committee. You've been someone that has been a delight to work with and to get your guidance in terms of the direction that we think the Fed needs to take in order to assure our public and that there's a steady hand at the helm. So we thank you for coming this morning and look forward to your testimony, and then we'll have questions from our committee.
Thank you for those kind comments. It's my pleasure to be here. Chairman Coates, Ranking Member Maloney, and members of the committee, I appreciate the opportunity to testify before you today. I will discuss the current economic outlook and monetary policy. The U.S. economy has made further progress this year toward the Federal Reserve's dual mandate objectives of maximum employment and price stability. Job gains averaged 180,000 per month from January through October, a somewhat slower pace than last year, but still well above the estimates of the pace necessary to absorb new entrants to the labor force. The unemployment rate, which stood at 4.9% in October, has held relatively steady since the beginning of the year. The stability of the unemployment rate, combined with above-trend job growth, suggests that the U.S. economy has had a bit more room to run than anticipated earlier. This favorable outcome has been reflected in the labor force participation rate, which has held steady this year despite an underlying downward trend stemming from the aging of the U.S. population. While above-trend growth of the labor force and employment cannot continue indefinitely, there nonetheless appears to be scope for some further improvement in the labor market. The unemployment rate is still a little above the median of Federal Open Market Committee participants' estimates of its longer-run level, and involuntary part-time employment remains elevated relative to historical norms. Further employment gains may well help support labor force participation as well as wage gains. Indeed, there are some signs that the pace of wage growth has stepped up recently. While the improvements in the labor market over the past year have been widespread across racial and ethnic groups, it's troubling that unemployment rates for African Americans and Hispanics remain higher than for the nation overall, and that the annual income of the median African American household is still well below the median income of other U.S. households. Meanwhile, U.S. economic growth appears to have picked up from its subdued pace earlier this year. After rising at an annual rate of just 1% in the first half of this year, inflation-adjusted gross domestic product is estimated to have increased nearly 3% in the third quarter. In part, the pickup reflected some rebuilding of inventories and a surge in soybean exports. In addition, consumer spending has continued to post moderate gains, supported by solid growth in real disposable income, upbeat consumer confidence, low borrowing rates, and the ongoing effects of earlier increases in household wealth. By contrast, business investment has remained relatively soft, in part because of the drag on outlays for drilling and mining structures that resulted from earlier declines in oil prices. Manufacturing output continues to be restrained by the weakness in economic growth abroad and by the appreciation in the U.S. dollar over the past 2 years. And while new housing construction has been subdued in recent quarters, despite rising prices, the underlying fundamentals, including a lean stock of homes for sale, an improving labor market, and the low level of mortgage rates, are favorable for a pickup. Turning to inflation, overall consumer prices, as measured by the price index for personal consumption expenditures, increased 1.25% over the 12 months ending in September, a somewhat higher pace than earlier this year, but still below the FOMC's 2% objective. Much of this shortfall continues to reflect earlier declines in energy prices and in prices of non-energy imports. Core inflation, which excludes the more volatile energy and food prices and tends to be a better indicator of future overall inflation, has been running closer to 1.75%. With regard to the outlook, I expect economic growth to continue at a moderate pace, sufficient to generate some further strengthening in labor market conditions and a return to the committee's 2% objective over the next couple of years. This judgment reflects my view that monetary policy remains moderately accommodative and that ongoing job gains, along with low oil prices, should continue to support household purchasing power and therefore consumer spending. In addition, global economic growth should firm, supported by accommodative monetary policies abroad. As the labor market strengthens further and the transitory influences holding down inflation fade, I expect inflation to rise to 2%. I will turn now to the implications of recent economic developments and the economic outlook for monetary policy. The stance of monetary policy has supported improvement in the labor market this year, along with the return of inflation toward the FOMC's 2% objective. In September, the committee decided to maintain the target range for the federal funds rate at 0.25 to 0.5%, and stated that while the case for an increase in the target range had strengthened, it would, for the time being, wait for further evidence of continued progress toward its objectives. At our meeting earlier this month, the committee judged that the case for an increase in the target range had continued to strengthen, and that such an increase could well become appropriate relatively soon if incoming data provides some further evidence of continued progress toward the committee's objectives. This judgment recognized that progress in the labor market has continued and that economic activity has picked up from the modest pace seen in the first half of this year. And inflation, while still below the committee's 2% objective, has increased somewhat since earlier this year. Furthermore, the committee judged that near-term risks to the outlook were roughly balanced. Waiting for further evidence does not reflect a lack of confidence in the economy. Rather, with the unemployment rate remaining steady this year, despite above-trend job gains, and with inflation continuing to run below its target, the committee judged that there was somewhat more room for the labor market to improve on a sustainable basis than the committee had anticipated at the beginning of the year. Nonetheless, the committee must remain forward-looking in setting monetary policy. Were the FOMC to delay increases in the federal funds rate for too long, it could end up having to tighten policy relatively abruptly to keep the economy from significantly overshooting both of the committee's longer-run policy goals. Moreover, holding the federal funds rate at its current level for too long could also encourage excessive risk-taking and ultimately undermine financial stability. The FOMC continues to expect that the evolution of the economy will warrant only gradual increases in the federal funds rate over time to achieve and maintain maximum employment and price stability. This assessment is based on the view that the neutral federal funds rate, meaning the rate that is neither expansionary nor contractionary and keeps the economy operating on an even keel, appears to be currently quite low by historical standards. Consistent with this view, growth in aggregate spending has been moderate in recent years, despite support from the low level of the federal funds rate and the Federal Reserve's large holdings of longer-term securities. With the federal funds rate currently only somewhat below estimates of the neutral rate, the stance of monetary policy is likely moderately accommodative, which is appropriate to foster further progress toward the FOMC's objectives. But because monetary policy is only moderately accommodative, the risk of falling behind the curve in the near future appears limited, and gradual increases in the federal funds rate will likely be sufficient to get to a neutral policy stance over the next few years. Of course, the economic outlook is inherently uncertain, and as always, the appropriate path for the federal funds rate will change in response to changes to the outlook and associated risks. Thank you, and I would be pleased to answer your questions.
Chair Yellen, thank you for your opening statement. Something caught my attention during that statement that I hadn't, in reading your statement earlier, hadn't just caught my attention. You stated that the case for an increase in the prime rate relatively soon, unless, it was the word unless that perked me up a bit, further evidence indicated to the contrary. My question to you is are the results of the election does that fall in the category of unless, and what is the FOMC, how is it looking at that in terms of the decision that the case for an increase is still relatively soon?
Well, my own judgment is looking at incoming economic data and developments thus far affecting the outlook, that the evidence we've seen since we met in November is consistent with our expectation of strengthening growth and improving labor market, inflation moving up. So we indicated that the case had strengthened for an increase in the federal funds rate, and To my mind, the evidence we've seen since that time remains consistent with the judgment the committee reached in November. Now, obviously, there are many economic policies that Congress and the administration will be considering in the months and years to come. And when there is greater clarity about the economic policies that might be put into effect, the committee will have to factor those assessments of their impacts on employment and inflation and perhaps adjust our outlook depending on what happens. So many factors over time affect the economic outlook and the appropriate stance of policy that's needed to achieve our dual mandate employment and inflation objectives. But at this stage, I do think that the economy is making very good progress toward our goals, and that the judgment the committee reached in November still pertains.
Thank you. You've suggested publicly that fiscal policy should play a role in stimulating economic growth. As I mentioned in my opening statement, any new economic growth initiatives envisioned by the next Congress and the next administration should include a full accounting of its potential effects on the economy. And from your perspective, how would you balance the need to promote economic growth with the realities associated with deficit spending and high and rising debt? I assume we are looking at some type of a balance there. How can that be achieved?
Well, it's clearly up to Congress and the administration to weigh the costs and benefits of fiscal policies that you will be considering. My advice would be that several principles should be taken into account as you make these judgments. First of all, the economy is operating relatively close to full employment at this point. So in contrast to where the economy was after the financial crisis, when a large demand boost was needed to lower unemployment, we're no longer in that state. You mentioned the longer-term fiscal outlook. The CBO's assessment, as you know, is that there are longer-term fiscal challenges, that the debt-to-GDP ratio at this point looks likely to rise as the baby boomers retire and population aging occurs, and that longer-run deficit problem needs to be kept in mind. In addition, with the debt-to-GDP ratio at around 77%, there's not a lot of fiscal space should a shock to the economy occur, an adverse shock that did require fiscal stimulus. I think what's been very disappointing about the economy's performance over the last, really since the financial crisis, or maybe going back before that, is that the pace of productivity growth has been exceptionally slow. The last 5 years, 0.5% per year. The last decade, 1.25% per year. The previous 2 decades before that were about a percentage point higher. And that's what ultimately determines the pace of improvement in living standards. So my advice would be, as you consider fiscal policies, to keep in mind and look carefully at the impact those policies are likely to have on the economy's productive capacity, on productivity growth, and to the maximum extent possible, choose policies that would improve that long-run growth and productivity outlook.
Thank you. My time has expired, and so I'm going to turn to Congresswoman Maloney for her questions.
Thank you, Mr. Chairman. And thank you for your service. We will miss you. Thank you. Can you envision any circumstances where you would not serve out your term as chair of the Federal Reserve?
No, I cannot. I was confirmed by the Senate to a 4-year term, which ends at the end of January of 2018, and it is fully my intention to serve out that term.
Thank you. The election outcome introduced new uncertainties that the markets and the private sector had not expected and priced in. And how do these uncertainties affect the Fed's decision in the next meeting?
Well, the markets try to anticipate what policies Congress and the administration will put into effect. And we have seen some significant market moves since the election. In particular, longer-term Treasury yields are up about 40 basis points, and the dollar is strengthened about 3.5%, a broad index. My interpretation would be that markets are anticipating that you will ultimately choose a fiscal package that involves a net expansionary stance of policy, and that in a context of an economy that's operating reasonably close to maximum employment with inflation heading back toward 2%, that such a package could have inflationary consequences that the Fed would have to take into account in devising policy, and that the market response is consistent with that view. So, from our point of view, we don't know what's going to happen. There's a great deal of uncertainty. Right now, I've tried to offer you my assessment of where the economy is and what policy response is appropriate in the months ahead. Given my current assessment, we will be watching the decisions that Congress makes and updating our economic outlook as the policy landscape becomes clearer, and taking into account the shifts in the economic outlook for the appropriate stance of policy. But I think that is how I would interpret the market response. But things could turn out very differently, we understand, and we will simply watch what decisions are made and factor them into our thinking going forward.
Does the lack of information warrant a delay in raising the interest rate, say until the January meeting when you'll have more information?
Well, my guess is that uncertainty about these matters will last for some considerable time, and we have had an accommodative monetary policy. I do think, and we have said, the committee has said for a long time, that gradual increases in the federal funds rate are likely to be appropriate to promote our objectives. And my assessment of where the economy is and how it's been operating, and the fact that near-term risks do seem reasonably balanced, I would think that the judgment that the committee reached in November remains the appropriate one.
And Chair Yellen, one of the most significant responses to the financial crisis was passage of the Dodd-Frank law. Today, as a result of this law, the financial system is stronger, safer, and more stable. How do you feel about repealing Dodd-Frank?
Well, I agree with your assessment. We lived through a devastating financial crisis, and a high priority, I think, for all Americans should be that we want to see put in place safeguards through supervision and regulation that result in a safer and sounder financial system. And I think we have been doing that, and our financial system, as a consequence, is safer and sounder. And many of the appropriate reforms are embodied in Dodd-Frank. We now have much higher capital than before the crisis, much more stringent liquidity requirements. Derivatives, standardized derivatives are now subject to central clearing, and derivatives both cleared and uncleared are subject to margin requirements that increase their safety. We have a new orderly liquidation authority. We're focusing on resolution through an ending too big to fail through the living wills process, which I think is really changing the mindset of large financial firms about how they need to run their businesses and making them safer and sounder. And Dodd-Frank placed considerable emphasis on financial stability. We now have a group, the FSOC, that meets all the regulators to consider threats to financial stability. So I think Dodd-Frank was very important in fostering those changes, and we should feel glad that our financial system is now operating on a safer and sounder footing.
Thank you, and my time has expired, but I just have to ask you very quickly, do you have concerns that the repeal would make another financial crisis more likely?
I certainly would not want to see all the improvements that we have put in place. I wouldn't want to see the clock turn back on those, because I do think they're important in diminishing the odds of another financial crisis.
Thank you for your service.
Thank you.
Thank you, Congresswoman. Our Vice Chairman, Mr. Teaberry.
Thank you, Chairman. I am bookended by two individuals who are going to retire at the end of this session, and it's been an honor and privilege to serve over the past year on this committee with both of you. Mr. Hanna has brought so much business expertise, and Chairman, if there were a picture in the dictionary of Indiana nice, you'd be that picture. It has been an honor and privilege to serve with you. You will be missed. I'm comforted only by knowing that your replacement, my colleague, Senator-elect Todd Young, is as nice and as smart as you. So, a great successor.
He's actually smarter. But thank you for the compliment.
Thank you. It's been an honor to serve with you here. Chair Yellen, it's an honor to have you here. Thanks for your time. In a story this month in the Wall Street Journal, they reported that for the first time in more than 30 years, banks, credit unions, and other depository institutions' share of the mortgage market fell below 50% because of banks' aversion to risk and fear of legal and regulatory issues. And while some lending has increased, banks have shifted clearly to jumbo mortgages and borrowers who have the best credit. Loans to small businesses have lagged, and new rules for credit cards may be hindering lending as well. President-elect Trump has said that Dodd-Frank is, and I quote, a tremendous burden to the banks. He's expressed the same concerns that the banks are unable to lend to people who actually need it, people who want to start a new business or expand a current business, which has made us less competitive and has slowed growth. His view is shared by many community bankers, by small and medium-sized business owners, and by many economists across our country. Further, the GAO just released its study of the Federal Reserve's bank stress test procedures and had 15, as you know, recommendations for making improvements that go beyond what Governor Tarullo recently outlined as next steps. Chair, what are your responses with respect to the following issues? The current state of bank lending, the constraining effects of regulation generally and stress tests in particular, and finally, the impact on the economy's ability to grow and create jobs. And one last thing, do you plan on adopting the GAO's stress test recommendations on improving transparency, model design and management, and cost-benefit analysis? And any of that I asked, if you can't respond to today, I certainly understand. If you could reply in writing, would certainly appreciate it.
Let me take a shot at replying, and if there's something that I don't cover, I'd be glad to respond. So let me just start by saying something about the burdens on community banks. Community banks play a very important role in our economy, in lending, understanding the conditions in their communities, and providing lending that supports economic growth. And it's really critical that they be able to function and to thrive. We recognize, we talk to community bankers regularly and recognize that the burdens that they're operating under are significant, and want to do everything that we can to reduce those burdens and to simplify the compliance regime for those banks. We've taken many steps on our own to reduce the burdens of our supervision, and we're contemplating ourselves. The regulators are working on possible proposals for a simplified capital regime that would apply to smaller community banks. So I completely agree those banks play a critical role, and we need to focus on reducing burden. Now, of the Dodd-Frank rules, many of them apply particularly to the largest financial institutions, and the most significant increases in capital requirements, including surcharges for the largest capital surcharges for the largest firms that create the greatest systemic risk, the burdens of stress tests, and other regulatory requirements fall on those firms that I do think pose potential threats to financial stability. And it is important that those institutions maintain higher standards of safety and soundness. You mentioned the stress tests and GAO's finding. Stress tests have been central to the Federal Reserve's efforts to increase capital and ensure that capital planning in large systemic financial institutions, that capital planning takes into account an accurate assessment of the risks that could strike banks. And the GAO in their review found generally that our CCAR and DFAST stress tests are effective, are useful. They suggested some changes, many of which we had already considered or had underway, and their suggestions are useful, and we intend to take them up or look carefully at it. So it was a very useful report, but bottom line, it concluded that our stress testing regime has resulted in a very substantial improvement to safety and soundness. I should say that we recently put out a new regulation that will reduce the burden of the stress testing regime on institutions between $10 billion and $250 billion in size, or I guess $50 billion and $250 billion, that those institutions will no longer be subject to the qualitative part of our so-called CCAR capital review process, that we will no longer object to capital distributions based on qualitative evaluation of their capital planning process, that we will look at their capital planning process through normal supervisory methods. And I think that that will serve to reduce burden on a number of large but smaller institutions subject to the stress test. And finally, you asked me about bank lending and mortgages. I think certainly mortgage credit standards have tightened up, and there are borrowers who are finding it difficult with lower credit ratings to obtain mortgage credit. I think it is a consequence of the financial crisis, regulations, and greater caution on the part of lenders. I think we wouldn't want to go back to the mortgage lending standards that we had in the first decade of this century that led to the financial crisis, but they certainly have increased. On small business lending, I think my assessment there would be that it remains largely available and that banks find, and this is something you also see in surveys, that the demand for borrowing by small businesses has not been very robust in recent years. In part, I think they see their sales are not growing sufficiently rapidly to justify much borrowing. Certainly the community banks and other banks that we talk to and monitor suggest that they stand ready and have adequate resources to support additional lending to smaller businesses. But there is a question there as to whether that is a demand or supply issue.
Thank you, Congressman. I've just been alerted that the House has been called for a vote, which may scramble, but we'd love for you to vote and come back, and we'll keep your place in mind. And those of my senators, as I look down the line, are smiling because that means they move up on the list. Let's see. Senator Klobuchar, you're next on the list, and vote, come back, and we'd love to have you back, and we'll keep you on the list.
Okay, very good. Well, thank you very much, Madam Chair. And just to follow up on Representative Teaberry's questions on community banks, I appreciated that. You and I have discussed that many times, and I think I'll just put some additional questions on the record. As you know, I'm concerned about the status of community banks and what's been happening the last few years. I just wanted to start out with a question about the importance of independence for the central bank. I know you can't comment on political goings-on, but you may have noticed there was some campaigning going on in the last year, and the Federal Reserve was discussed a few times. Could you comment on the importance of preserving the independence of the Federal Reserve Bank from interference by either the executive branch or the legislative branch, and what that would mean for monetary policy effectiveness if there wasn't a sense of independence of the bank?
Thank you for that question. I think the independence by a central bank to make tactical decisions about implementation of monetary policy subject to a congressional mandate, which we have. Obviously, we are accountable to Congress. We're a creature of Congress. Congress has established goals for us of maximum employment and price stability. But it's critically important that a central bank have the ability to make judgments about how best to pursue those goals while being accountable for explaining its decisions and transparent in its decision-making. Central banks around the world in recent decades have gained this independence, and the economic outcomes that have resulted from this trend towards central bank independence, we have seen much better macroeconomic performance.
So there's actually studies showing that banks that have that sense of independence, that there have been improvements in those countries?
Yes, there is clear evidence of better outcomes in countries where central banks can take the long view, are not subject to short-term political pressures, and sometimes central banks need to do things that are not immediately popular for the health of the economy. And we've really seen terrible economic outcomes in countries where central banks have been subject to political pressure. Often it's the case when a country is not able to balance its budget, is running large deficits, is finding it hard to finance those deficits. How can you finance it? You realize you can go to the central bank and force it to buy the debt that's being issued. And the story in every country that's experienced very high or even hyperinflation is one where a central bank has been forced to follow the dictates of a government that has compromised its independence. So markets come to expect low and stable inflation from a central bank that has political independence and good economic performance. And I believe we've seen that both in the United States and globally.
Thank you. You know, we have the Fed dual goal of maximum employment and price stability. There have been some talk of out there of just eliminating one of the goals and just focusing on price stability. And there's also been comments to have the Fed target a certain growth rate for the economy. What do you think that would be the effect of that, to either limit the Fed's focus to stabilizing prices, get rid of the other part of the dual mandate, or putting in targeting a certain growth rate?
So I am a strong believer in the Fed's dual mandate. It was Congress's decision, and of course it is up to Congress what our mandate should be. But I believe that both of these, both price stability, the rate of inflation, having that low and stable, and employment matter greatly to the American people. They both impact the welfare of households and individuals in this economy to a great extent, and I think they're both appropriate goals. Price stability is a goal of every central bank. Most central banks also take employment or real side performance into account in achieving it. Now, I would say, really, there is rarely any conflict between pursuing these two objectives. So it's not commonly the case that they could be in conflict, but most of the time they're not. And if you think about what we've faced, the Federal Reserve in the aftermath of the crisis, we've had very high unemployment that we wanted to bring down as rapidly as possible, and inflation that has been almost consistently below our 2% objective. And so our efforts to put in place a highly accommodative policy were directed toward achieving both of those goals, and they have not been in conflict. With respect to a growth rate objective, we can't independently, if we are to achieve our inflation objective, simply choose some arbitrarily chosen growth rate objective and try to achieve it. If we try to do that, and it's one that's not consistent with the underlying productive potential of the economy and the economy's ability to grow based on changes in technology and capital and labor over time, we would end up with an economy that either has inflation that's above acceptable levels or conceivably deflation if the target were chosen too low.
All right. Thank you very much. I'll ask my questions on the record, Mr. Chair, on infrastructure funding, the effect in the economy, something the President-elect has discussed, and then also and the positive of doing that, and then income inequality and some of your views on that. Thank you very much.
Thank you, Senator.
Thank you.
Senator, thank you. And I know the members of the committee will miss your presence in the future as you're moving on to greater responsibilities.
Well, I may still be on the committee, but yes, my presence at the front of the line, you mean? Yes.
The front of the line, yeah.
All right. Thank you.
Congressman Hanna.
Thank you. We talked about Dodd-Frank. Prior to Dodd-Frank, the Federal Reserve examiners took responsibility for the safety and soundness of money as well as consumer protection oversight. Dodd-Frank moved that over to the CFPB. And yet, in 2015, the LA Times reported that Wells Fargo, with cross-selling pressures on consumer bankers, was encouraging fraud. Wells Fargo paid $185 billion in fines. And I know this is somewhat of a hypothetical, but I'm curious. So Dodd-Frank in this instance, with whoever's doing this, missed this, and it's a profound miss. Do you think it would have been any different had it been left with the Federal Reserve?
Well, we've cooperated historically with other regulatory agencies to engage in examinations. And in this case, the Consumer Financial Protection Bureau was involved, the controller of the currency. Most of the abuses that occurred were in the national bank, where the controller of the currency also has responsibilities. That's been historically true. So, you know, they did find these problems. They have levied significant fines and put in place enforcement actions to correct them. We, in 2011, looked at a subsidiary we were then responsible for, which was the independent mortgage company, and found abuses which we fined Wells Fargo for and put in place enforcement actions. I think we've all worked together pretty constructively to try to address abuses. I mean, I would say that we, going forward in the institutions that we supervise, our state member banks, are looking to see if there are similar practices that could cause problems. And with the holding companies we supervise of the largest institutions, we have undertaken a thorough horizontal review of compliance practices, but we do work constructively and collaboratively with the other agencies.
So there's no real disconnect that you can identify because of this Dodd-Frank?
There are many agencies in the United States involved in supervision, and we do try to work constructively together. And I think we've had a good working relationship with those other agencies, so I wouldn't want to levy a criticism there.
Sure, I understand. In previous hearings, we discussed student debt, the massive amount of student debt, and how that impacts starting a family, having a home, doing all those things that people used to do at a much younger age. How do you take that into account? How does the Fed take that into account when they consider all the things that they look at? I mean, it is somewhat like consumer debt out there, this $1 trillion number that is haunting and hanging over everyone's head. But how does the Fed think about it going forward?
So we have been very attentive to trends in student debt, and as you say, it really has escalated to an extraordinary degree. There's a good deal of research that is trying to determine whether or not student debt burdens might be impeding household formation. Household formation has been very low. The number of young people who are purchasing new single-family homes has been quite depressed, and we've seen less of a recovery in the housing sector and pickup in housing starts than we would have expected. Multifamily's been quite strong, but single-family construction's been depressed. There are a number of factors, I think, that are contributing to that, and there are, you know, some research that suggests student debt is a factor that is leading to the decision to reduced willingness of millennials to buy single-family homes. They're marrying later, getting more education, living more in cities, have more student debt. It's difficult to sort out exactly what the most important drivers are, but that could be one of them.
Thank you. Thank you. It's interesting how we study things. Bob Dylan said, I think it was him, said you don't need a weatherman to know which way the wind blows, and we spend a lot of time figuring out things that are kind of patently obvious. But thank you for your time today.
Thank you.
Thank you, Congressman. Senator Peters.
Well, thank you, Chairman Coates. And before I begin my question, I just want to thank you. It's been a real pleasure and an honor to be on this committee with you, and wish you well in your future endeavors. And Chair Yellen, wonderful to be with you here today, and thank you for taking the time. And I certainly know that you understand that politics shapes American democracy in sometimes very unpredictable ways, and we have to be prepared for that unpredictability. And in times of uncertainty and change, one thing that always seems clear, that always stands out, is that Americans care about the economy, usually first and foremost, and they're concerned about their pocketbooks, their futures. They want good jobs, they want growth, better chance for their children. And while politics that shape our democracy don't always follow any kind of predictable pattern, all of us need some measure of stability and certainty, be it markets, consumers, savers, spenders, retirees, young professionals, the list goes on. Thankfully, to paraphrase President Obama, the federal government remains an ocean liner, not a speedboat. But there still remains without question a level of uncertainty about the near term of fiscal policies in this nation. So I just wanted to say how much I appreciated your comments on the independence of the Fed and the necessity for that. Monetary policy has been, and I certainly think must continue to be, a balance and a complement to fiscal policies of the federal government. And I also think that unfounded accusations that the Federal Reserve monetary policies are somehow political in nature can be one of the most damaging claims that can happen in a modern democracy. Certainly, as policymakers, I believe that we have a role to express our views on individual monetary decisions, whether in criticism or in praise. But to undermine the independence and the credibility of the Federal Reserve is a very dangerous action that may be very difficult to undo once it is out there. And I don't believe these are just abstract discussions. The potential for undermining the credibility of a central bank will have a direct impact on the economy and ultimately on our constituents back home. And I believe that members of Congress have the added responsibility as elected officials to uphold these important norms that have guided our country for decades. With that, I would urge my fellow policymakers here in both the legislative and executive branches to exercise caution and prudence when it comes to these types of criticisms. But turning to a question, Chairman Yellen, I believe that perhaps one of the greatest challenges that we face in our banking system today is cybersecurity. And from a consumer level to commercial level to the level of global banking system, we face tremendous threats every single day, as I know you are well aware. The warning signs are very evident. One example was in February 2016, hackers successfully stole $81 million from Bangladesh Central Bank by sending false payment requests to the New York Federal Reserve. Since this hack was first reported, additional breaches have been uncovered, including attacks in Vietnam, Ecuador, and more. These hacks have all been through the SWIFT, Society for Worldwide Interbank Financial Telecommunications Banking Network, used worldwide by more than 11,000 financial institutions. And I use this example not to speak ill of SWIFT, who has pledged to take steps to strengthen the security and that of their partners, but rather to just illustrate on a global level that we are only as strong as our weakest link when it comes to cybersecurity. In August of this year, I wrote President Obama to put the topic of international cybersecurity on the G20 agenda, and in the months followed, I'm pleased that the Group of Seven introduced 8 suggested principles for private firms and government agencies to follow. And I continue to believe this is an issue that we must do in a collaborative and international manner. So my question to you, Chair Yellen, is what steps has the Federal Reserve taken to ensure both internal cybersecurity as well as cybersecurity of financial institutions overseas? You currently play a central role, will continue to play a central role. What assurances can you give us, please?
So let me start by saying that I agree very much with your assessment. This is one of the most significant risks our country faces, and we are cooperating with other regulators, as you indicated, internationally, working with the G7, cooperating with financial institutions to make sure that we have a system that is prepared to deal with cybersecurity risks. We are very focused on this in our own operations, and I can provide you more details if you're interested in the various things that we're doing to make sure that our own systems are safe and meet the highest standards. We're also working closely with financial institutions to make sure that the controls that they have in place are appropriate. It's a key part of our supervision. We recently put out an advance notice of proposed rulemaking that suggests higher standards of cybersecurity protections for institutions that are systemically important, and for those that are really interconnected, where a problem could spill over to the entire financial system, we are proposing the very highest standards that those firms should meet, given the fact that they could be a source of vulnerability to the larger financial system. But I would say that while we're focused on this in our own supervision, and we're working closely with other financial regulators and with the U.S. Treasury has taken the lead here, this is something that Congress needs to look at very carefully. It's not just a matter of the Fed and financial institutions. Risks involve merchants and others involved in the economy, and it is a very broad threat that we alone are not able to deal with adequately. I hope you will stay involved.
Well, I will, Chair Yellen, and I look forward to taking you up on your offer to sit down and have more detailed discussion as to what is happening at the Federal Reserve. I serve on Commerce as well as Homeland Security Committee, so all of this merges together in addition to what we're doing here. And again, this is, as you stated yourself, the most significant threat that we face now is cybersecurity. So I look forward to working closely with you. Thank you for your testimony today.
Thank you.
Okay, well, I got members coming back and forth. We had this Byzantine process of going forward here. I think you're between votes, is that what you said? And see on the list of, yeah. We're going to give you your 5 minutes, and then Senator Lee will be next.
Thank you. One of the controversial things of the Federal Reserve, and I want to ask you about this, is last time we were in a crisis, you bought a lot of mortgage-backed securities, correct?
We did.
And do you feel you paid above market value for those securities, or did you pay above market value for those securities?
No, we always purchase securities in the open market at market prices.
Okay. Could you give me a description of other private bonds that you purchased over the last few years?
We have not purchased private bonds. We're only allowed to purchase Treasury and agency securities.
Okay, well, how do you describe mortgage-backed securities?
Well, those are agency securities. They're issued by Fannie and Freddie. And
okay, so you consider that the equivalent of a government bond?
Well, it's an agency bond, and that those are permissible investments for us. We buy securities in the open market in a bidding process, an auction process that we purchase at market prices.
And do those mortgage-backed securities, do they have a face value, so to speak, or do they, I guess I'll describe it that way. Do they have a face value, or is there a value as if, say, all the mortgages would be paid in full?
They do have a face value, and then, of course, they trade in the market, and prices can deviate from those face values.
And when you were purchasing them, what were you paying compared to the face value?
So I honestly don't have, we've published that information. I don't have that information.
Do you have just a wild guess? And I know maybe it's an unfair question. 90%, 80%, 70%? Just wildly?
We would have been paying market prices for securities at that time.
Yeah, I know, but you know, about was that 70% of face, 80? Do you have I'm not going to, I realize you don't know exactly, but you must know about.
I don't think the discounts were nearly that deep, but I may be wrong.
Okay. Okay, that's my final question.
Congressman, thank you. Senator Lee.
Thank you very much, Mr. Chairman, and thank you, Chair Yellen, for being with us today. In 2013, there were 12 banks, as I understand it, that controlled 69% of the industry assets. And I think we've been seeing a market increase in the share of revenues concentrated in a relatively small handful of firms. I see you're nodding. I assume that means you would not disagree with that.
I believe that's true.
And then there was the economic census of 2012, and we learned from that study that there were some 33,000 fewer business establishments in the finance and insurance industry than there were in 2007. So over that 5-year period, we saw 33,000 business entities that left the market or were consolidated into something else. I think it's worth evaluating the potential problems that an increasingly concentrated and potentially less competitive banking sector might pose, especially in light of some of the concerns surrounding the too big to fail concern. So let me ask you this, Chair Yellen, what risks do you see that might come from the concentration of power, the concentration of market share within the financial industry? What risk do you think that might pose to our overall financial stability?
So large, interconnected, complex firms, it's not just a question of size, but size is part of it, but other characteristics matter too. Their distress or failure could pose significant risks to financial stability, and a great deal of our regulatory and supervisory response since the financial crisis has been directed at those firms that do pose such systemic risks. And we have imposed much higher capital standards and capital standards for individual firms that reflect our assessment of the individual risks that each of those systemic firms poses to our financial system. Because of the risks they pose, they need to have a lower probability of distress, to be better managed, have more liquidity, to have resolution plans, that we need to make sure these entities are resolvable and diminish their risk of failing. And we have, through our stress tests and capital requirements, resolution plans, living wills, and other things, have improved the safety and soundness, especially of those institutions.
Let's talk about those efforts for a minute. You mentioned stress tests in particular. Since the enactment of Dodd-Frank and over the last few years, the Fed has undertaken various measures, some of which you referred to, of regulatory enforcement. I wonder whether some of those efforts might undermine the due process interests of those who own the banks, not just the banks themselves, not just the wealthy people who are invested in them, but also the many people, including retirees, who invest in them. A longstanding concern of due process involves certainty in the law. James Madison described this in Federalist 62 when he said that the people, it'll be of little avail to the people that their laws may be written by individuals of their own choosing if those laws be so voluminous, complex, and ever-changing that they cannot be understood, or if they undergo such incessant changes that no person who knows what the law is today can be sure what it will be tomorrow. My understanding of these stress tests is that the standards are constantly changing. and there's kind of a black box. And so they don't know what the law is today, and they know even less about what the law will be tomorrow. If by the law we mean the standards enforceable by the Fed that carry the force of law will be. How is that consistent with due process, and how can the lack of transparency be consistent with our time-honored standards of due process?
So I would disagree that there's a lack of transparency. While we do not publish the precise mathematical formulas that are used to evaluate bank portfolios, we have published and shared with the industry a great deal of information about the models that we use. We have
a great deal of information about them, but that doesn't mean that they know what the models are. And the models themselves are the basis for legal standards to which they're subject, are they not?
We want these banking organizations to have sound risk management, and that means developing their own capacity to evaluate the risks in their portfolios rather than using a model that we hand them. And the GAO review of our stress testing did not recommend, they looked at this very carefully, and they did not recommend that we share with the industry the exact details of the model. We have put out for public comment policies about how we design stress test scenarios. The industry understands how we go about devising those scenarios, although they change from time to time, and they have a great deal of information about the models that we use and what's contained in it. But we want to make sure that they have appropriate incentives to analyze their own unique risks of those organizations that may not be captured in our stress test, and that they build models that are appropriate for each individual firm.
My time's expired, and I've got to respect the clock and the chairman and my fellow committee members. I do want to point out that GAO did, in fact, recommend updating, revising the guidance. And I also want to be clear that I understand you've got a difficult job to do, and I understand these are very important things. But I don't think we can overlook the fact simply because something's important doesn't mean that we can subject the American people to laws that are constantly subject to change, laws that are not even written by individuals of their own choosing, laws written by people who are unelected and therefore unaccountable to the people. Doesn't mean they have bad intentions. It just means that there can be no due process in that environment, and I think we've got to take that into account. We need to be very mindful of that and look for ways to reform it. Thank you.
Thank you, Senator. Senator Casey.
Mr. Chairman, thank you very much, and I want to thank you, Senator Coates, for your service and the work you did working with Representative Maloney and others on this committee. So we're grateful for that, and wish you luck as you transition.
Thank you.
Madam Chair, we're grateful to be with you again, and thank you for your testimony. When you provide this testimony, we always learn from it.
Thank you.
And my copy of your remarks is highlighted in yellow, the parts that were most interesting to me, and I'll quote from them in a moment. But I wanted to focus on maybe one word, but unfortunately a vexing problem, and that's wages or lack of wage growth. We've had, I think, a basic disconnect lately where, with a good recovery, corporate profits are healthier, thank goodness, but the wage picture over time, not the most recent numbers, but over time, has been a different story. So we do have a disconnect where folks see corporate profits going up and Wall Street having good results and their own wages not growing over time. And I think it's a problem for both parties to come together and tackle it. I believe we need to focus on short-term strategies to deal with that, as well as kind of a set of long-term priorities that I'll just quickly mention. But we've seen, not just in the context of the election, but even prior to that, but maybe most especially, people leading lives of real struggle. And a lot of it is connected, of course, I think, to the wage issue. You're familiar with, I think most people are, one of the studies, the Economic Policy Institute, which basically said wages grew more than 90%, maybe as high as 91%, for 25 years after World War II, along with an alignment of productivity growth. And then, but then after that, roughly around 1973, even with productivity still increasing more than 70%, wages kind of flatlined by one estimate 11% over 40 years. If that data and that analysis is in any way accurate, and I believe it is, we're looking at wage growth of 11% over 40 years. What we can't endure is another 20 or 30 or 40 years of that kind of wage growth. So what do we do about it? Well, one thing we need to do, I think, is to focus on ways to help communities when they are dramatically affected by substantial job loss in the short term. Thinking of a place like Erie County, Pennsylvania, the city of Erie and the county of Erie, they've suffered a lot of job losses when GE moved jobs down to Texas. One of the things I hope we could do, and something that I've been advocating for, is having measures that will provide immediate and targeted assistance to communities that have that seismic impact that leads to a lot of job loss. Over time, though, I think we need to focus on more strategic actions, quality, affordable child care, a real commitment to early learning, which we don't really have as a nation. And then some of the things we've heard a lot about lately, and I hope we can get agreement on both parties, investments in infrastructure, and not only the more traditional roads, bridges, infrastructure, but also broadband deployment. Pretty hard to grow a business or run a family farm if you're in a smaller community that doesn't have access to broadband, especially in rural America where the problem is really alarming. Huge percentages of rural America, rural Pennsylvania that don't have broadband. So that's a lot to chew into, but I want to get your sense of what you, not what you hope we would do, but maybe from the vantage point of what you think works. Short-term strategies to raise wages, as well as long-term investments that might result in that, if you have any ideas about that or opinions about that.
So you pointed to the fact in your comments that the behavior of wages, the disappointing growth in wages, is not just a recent phenomenon. It's not just something that is associated with the Great Recession following the financial crisis, although that took a huge toll. Right. It's a longer-term trend. Many economists feel it reflects both technological change that has persistently favored skilled workers and diminish the job opportunities of those who do more routine or less skilled work. And globalization, I think, also played a significant role. And even though many economists believe that these forces are good for, in some sense, for the economy as a whole, there are many individuals who are very badly and very negatively affected by these trends. And I agree with your focus that it's important to think about how to help individuals who are not winners because of trends of technology and globalization, and how to put in place inclusive policies that will help those individuals and make sure that the gains are broadly shared in our society. I don't have foolproof method to do this, but you gave a very good list of things that are certainly worth for the Congress and administration to consider. Certainly when you see a rising gap between the wages of most skilled and less skilled workers, and that's occurred since the mid-'80s, that's in a way a signal that's saying investing in people, investing in education, investing in workforce development, training, We see now there are high levels of job openings, and yet there's a certain degree of mismatch of skills with openings, investing to make sure that individuals have the skills they need to fill the jobs that are becoming available. And there is a good deal of research on early childhood education that suggests that's important. So there are a wealth of investment possibilities that could help to mitigate this trend and other interventions. And I definitely think it's appropriate for Congress and the administration to consider a broad range here.
Well, I appreciate that. Let me just say in conclusion, and do appreciate the feedback on that, that the part of your testimony, one part that I did highlight, which is good news on wages, you say in part, quote, some signs that the pace of wage growth has stepped up recently, unquote.
So
that's
we've
reflected in the 2015
yes.
wage increase.
Yes, so we are seeing some evidence, and I think that's good. But over the longer run, we do have a trend here, and it's important to do more than that.
Thank you very much. Thank you, Mr. Chairman.
Thank you. Senator Heinrich, you're on. Let me just state that in the shuffling that goes on between various Congresses, it appears that you are going to move up significantly into this chair, and so I welcome you to that. My understanding is the chairmanship now reverts back to the House, and it could be Mr. Teaberry, but we're not sure about that. But we're looking forward to your leadership here, but love to give you the chance here to talk to Chair Yellen, who
Thank you.
I would assume will be one of your key witnesses coming forward.
And Senator Coates, I just want to say how much a pleasure it's been to work with you both on this committee and also on the Intelligence Committee. Chair Yellen, I'm just going to jump into some questions because actually Senator Casey went really exactly where I want to go as well. The economy's come a long way in the last few years. It is certainly growing. But I think historically we've had this approach of if we can just make the economy grow, then a rising tide lifts all boats. And I at home hear from people, and we certainly saw, I think, the same sentiment in the recent election, that some of those boats just haven't been keeping up with the rest of us. And that is a fundamental problem with the quality of our economy. So things like wage growth, and particularly the seemingly broken link between productivity and wage growth. Some of the lack of wage growth you can ascribe to skilled versus unskilled. But we've also seen this very divergent path where historically we were able to keep wages sort of tied to the same trajectory as productivity, and we've seen those split apart. Do you have thoughts for why that is and how we can, seek through vocational training or other policies to relink those things together for a broad swath of America that is simply not feeling the benefits of a growing economy or a rising stock market?
So productivity growth is important over the long haul to real wage growth. And it has been extremely disappointing over the last decade. But I also agree with the point that you just made that we've had periods in which real wage growth has not kept up with productivity growth. That's also true. One way of data that shows that, if you look at the share of the pie, and here by pie I mean our gross domestic product, our output bundle of the economy, its division between rewards to labor and rewards to capital. That share was essentially constant for 100 years, and more recently we've seen an increase in the share of the pie going to capital. And that's consistent with real wages not keeping up with productivity. There is some research on that. The United States is not the only country that has seen that happen. I am not certain what the cause of it is, but I would agree with you that that is something that's happened. I think we're seeing a little bit of reversal of it now that the labor market is very tight and wages are increasing more rapidly. But even if wages were increasing in line with productivity, we do have the fact that we're seeing rising income inequality. We've been seeing that for a long time. A loss of middle-income jobs in the face of technological change and globalization that was probably accelerated in the aftermath of the financial crisis. So we have people who lost good jobs where they were earning good incomes, and even if they can find work, because after all, the unemployment rate is low and there are a lot of job openings.
But the
often
nature
they're
of those
not.
jobs really changed.
The nature of the jobs have changed, and the incomes are, so they're taking large wage hits, and we're seeing the frustration that comes with that. And we just go back to the points I made in response to Senator Casey's comments. I believe there are lots of things that could be considered that's not in the domain of monetary policy, but there's structural policies, training, education, and safety net.
Yeah. Okay. Well, you answered some questions earlier that were really focused on mortgages and the tightening mortgage requirements. I wanted to sort of cut quickly to the chase there and just ask you fundamentally, do you think, we all agree that we weren't getting the balance right when the mortgage crisis occurred. And certainly we've seen stricter requirements, and in large part, we've seen some benefits from that. But do you think we've gotten that right? Have we gone too far in tightening mortgage requirements, or have we gotten the balance right coming out of the mortgage crisis of 2007?
So that's a hard question, and I don't think I can give you a simple answer to that. I think it's appropriate that standards are tighter, but I think there are some groups for a variety of reasons that may be having an unduly difficult time in the aftermath.
Thank you, Chair.
Thank you. And Senator Cassidy.
And I also, Mr. Chair, thank you for your chairmanship for this past Congress, and thank you for your service to our country in a variety of ways.
Thank you.
As an ambassador, as many other things. So thank you. Madam Chair, thank you for being here. Thank you for all you do.
Thank you.
I'm very aware that your knowledge on all this greatly exceeds mine, so if I ask with trepidation, but I ask with sincerity. I had the privilege to have a conversation with one of your predecessors a few months ago, Alan Greenspan. I asked him, listen, this is the first time over 8 years we've never had GDP growth over 3%. Is this the new norm? He said it might be. That long-term capital investment continues to decline. Now, I have a graph. I'm sorry. I wish I could blow it up, but you think in numbers, so it probably makes it probably clear to you. It looks like since 2011, the year-over-year growth in capital expenditures by Fortune 500 companies has declined pretty significantly. And it occasionally levels, but then it begins to decline again. On the other hand, every time there's a QE, there is a spike in buybacks. So there are those who say the easy money has made it easier for big corporations to arbitrage as opposed to make money by long-term capital investment. Going back to my conversation with former Chair Greenspan, he said that if you go to a board of directors and you say we need a 30-year spending plan for capital investments, they're going to say, where's the certainty? On the other hand, if you say we can invest in whatever we invest in terms of the credit markets or the bond market, we can have a return, they will. So your comments, has perversely the QE hurt long-term capital investment? That's what I am told is key to productivity growth and rising wages and a rising GDP.
So there are a number of factors that have been depressing GDP growth. My colleagues now estimate that long-term growth rate is likely to settle under 2% without some change in policy. We have a more slowly growing labor force, and educational attainment of the workforce, which had been increasing at a more rapid rate, is now leveling off, and so there's less contribution there. I agree with you that capital investment has been weak, and that's one reason that productivity growth has been as depressed as it is. Even outside of investment, improvements in technology that come from other sources also seem to have diminished. Now, it's not clear, to my mind, why it is that investment spending has been as weak as it is. Initially, we had an economy with a lot of excess capacity. Firms were clearly operating without enough sales to justify a need to invest in additional capacity. And more recently, with the economy moving toward full employment, you would expect to see investment spending picked up, and it's not obvious exactly why it hasn't picked up. But I wouldn't agree that the Fed's monetary policy has actually hampered business investment or been a negative factor, and I'm not aware of any evidence that suggests that it is.
If I may, just because I'm almost out of time and Mr. Chair is going to wrap and then I'm through. I have a graph. So I have a graph that shows that in about 2008, the productivity began to climb. So you mentioned the excess capacity related to the great financial crisis. And then productivity began to climb. Around 2009, timing of QE1, it modestly began to decline. And then in QE2, it plummeted. And then it's kind of been like this, kind of lackluster, staying about the same on net since the end of QE2. So if what you're saying that the excess capacity associated with the recession had to shake itself out, it doesn't make sense to me that between 07 and 09 productivity would have grown so robustly.
So I believe what happened is we had a huge financial crisis. Firms found their sales collapsing, and they took measures that they thought was necessary for business survival, and that meant firing every worker that a company could possibly do without. And because layoffs were so huge, we saw a surge in productivity. They cut workforce to the bone and productivity surged. And those productivity gains continued for a while, but eventually the amount of labor that firms had was so low relative to their output that as hiring picked up and their sales picked up, productivity growth then subsided. There was a huge surge at the beginning as firms did everything in their power to cut costs.
Mr. Chair, can I ask
and it's not largely a reflection of trends.
And then, so for the specific question, if a company has a chance to go, as Mr. Greenspan, he wasn't related to this, so you may say that's not what he meant, and I'll accept that. But he said if a CEO could go to his board and say, we need to either make a 30-year investment with all the uncertainty of interest rates and regulatory environment, et cetera, versus invest in these financial instruments, that they are choosing the financial instruments over the productivity. Would you say that's true and relevant, true and unrelevant, or not true?
I mean, I think we do see a short-term focus in business decision-making that's disturbing, and the causes of that, I think, are not clear. And I certainly don't think it's our monetary policy, but it is true that businesses seem reluctant to commit to projects. In part, it suggests that they don't see that many projects that they think will produce returns that justify those investments. And it's conceivable that, we see evidence the pace of technological change is diminished, and it may be partly a reflection of that.
I thank you. I yield back.
Thank you, Senator. Well, I think we've come to the end of the session here. I just want to say that it's been a privilege for me to chair this committee. There are very few joint committees where House and Senate members gather together to address a particular topic or subject, and this is one of them. We have had a wealth of experienced and informed witnesses that have come before us on a variety of topics affecting our national economy and economic issues. We have made our records available to all House members and Senate members and to the general public. I want to personally thank my colleagues, most of whom have left here. Thank you, Senator Lee, for staying. But also the staff. We've just had a marvelous staff working together in a bipartisan, bicameral way, and that is not the norm here in the Congress, but it's a pleasure to do that. And the respect that I have for that staff and their working together is enormous. I want to give special thanks to Chair Yellen. She's our star witness. We've had many wonderful witnesses that have come before us here, but she's the star because the coordination between the Congress and the legislative branch and the Fed is extremely important to the economic future of our country. Chair Yellen has been more than available to come here and to speak with us, to deal with all the questioning that takes place, to better explain the role of the Fed in relationship to the role of the Congress and the legislative branch. She's been transparent, and as you have listened this morning, very thorough with her answers to our questions that have been raised. And so I just want to thank her for her availability. Wish you the best of success going forward. The future of our economy is much of it falls to obviously both areas here, the legislative as well as the administrative, but the Fed plays a very important role, and we certainly have learned a lot more about what the Fed is doing in your leadership, and we thank you.
Thank you, Senator. I really appreciate your kind words and want to say how much I appreciate your inviting me here to testify and how much I've enjoyed cooperating with you and appreciate your leadership.
Thank you.
Wish you the best in the future.
My parting gift to you, I knowing how busy you are, is that we're actually adjourning early and at least give you more lunchtime.
Thank you so much.
With that, this meeting concludes. Standard procedure. Let's see which way to go. Hey, it's been a joy. Thank you. It really is. Me too. And the best to you too. That'll be best for the country. Yeah. Thank you. Thank you. Hey, thanks, Mike. Yeah, thank you. It's been fun. It's like I said, we don't have any chances to combine the House and the Senate on topics like this. It's good to get them on the record. We're watching what they're doing. There are questions about what they're doing and how they're doing it. Successes and failures. So. Are you going to stay on? Yeah, it's good. You should.
Yeah, I'm looking forward to it.
Yeah.
Senator,
if you want to do an interview, just call my office.
Thank you.